Well, greetings everybody, and welcome back to our Dashboard Diagnostics series. We've been on something of a hiatus for a few months. Some of us here got married, others have just been off doing things, and we're kind of looking forward to kicking off the series again. I am joined here tonight by Ken Kabula and Lori Fredrickson, who will be helping with watching over you guys if you have any questions or that sort of thing. And by the way, congratulations, Lori and Paul. That's part of the hiatus, I'm sure. But we do look forward to going ahead and having these type of sessions again, and really glad to see all the people wandering into the room, and welcome back. We're going to kick off this return with a visit with one of our favoritists, if that's a word, sources of investment ideas. And in fact, Ken, you might have a few comments about the history of taking a look at this list over the years.
Yeah, Mark, I've been using this list, I don't know, for the last 8, 10, maybe longer. It used to come, I'm a subscriber to Forbes magazine, and so I used to get it on paper before Forbes even thought about having a website. And then in the last 7 or 8 or 9 years, it began to appear on the website. But it's a great source for good, high-quality small companies. I think Mark's going to talk a little bit about the methodology behind the list and how they come up with these companies. So all I'm telling you is I've made some excellent finds on this list. They're not all gems, believe me, but when you find companies that have good, solid fundamentals and have a little bit of history, you have a real chance to make some high-class money from these small companies on this list. I would urge you to take the 100 stocks on the list and sort them and play with them. I think we have a dashboard up on the Manifest website that lists all 100 of them. A couple we don't have followed in Manifest, but I think we have 98 out of the 100 followed. So take a look at them and do what you will with them. Find the highest quality. Look at their SSGs. Do some analysis. There's sure to be some good breakouts in here. There have been every single year, and I'm sure this year's no exception.
Well, it is that time of year. We use the image there as kind of our memory device to remind us to go looking for this. In fact, the day that Ken reached out and said that the list was out there, I had noticed Halloween candy while shopping, and I thought, hey, maybe it is time to check the Forbes list, and literally came home to a note from Ken. And Lori asked us to kind of take this whole theme maybe a little step further, and she wants us to kind of dig in and take a look at the performance of the stocks that have been featured over the years. And again, with our typical, are there any lessons or messages that we had to take away from that? So we'll do that as part of tonight's session also. Just a real quick disclaimer, this is an educational demonstration, and as always, no investment recommendation is intended. This is all for illustration purposes, and it's all for the purpose of demonstrating a philosophy and a process, and with emphasis on the philosophy part of it. Finding good companies at good prices, including smaller companies. I thought I would start with just a quick reminder as to why we even do this in the first place, and it has to do with just the knowledge, the awareness that growth is important in the design and management of any portfolio, and the role of growth, we know, kind of resides in this notion of having enough stalwarts, those big companies, those medium-sized workhorses, and the small promising companies in portfolios. And what you're looking at here is a quick look at one of our favorite small company mutual funds that's out there. It's known as Buffalo Small Cap, and the ticker symbol is, as you see right there, BUFSX. It's one of our favorite sources of ideas to study, watching over the shoulders of Kent Gassaway and his team out there. And on the left, I just took a snapshot. It's an excerpt of the portfolio just to show some of the kind of companies that are in the Buffalo Small Cap portfolio, with emphasis on, a little bit higher quality here than sometimes you'll find in some of the smaller company institutional funds. And notice the emphasis on growth. The overall average growth of the portfolio is 14.5%. That's actually among the highest out there. And here's kind of our reminder as to why this is important. Taking a look at the Buffalo Small Cap Fund is an example of what can be done with smaller companies, faster growing companies, you can see a 15-year track record of the Buffalo Small Cap Mutual Fund versus the S&P 500 down here. This red graph down at the bottom is the S&P 500. You can see that over approximately a 15-year period, it's up 5.5% a year, whereas the Buffalo Small Cap Fund is checking in way up here at 11%. So this is a fund that has a 5.5% relative return over 15 years and really meets the criteria of somebody who appears to know what they're doing, and we kind of like to watch over their shoulders. By the way, their turnover rate per year, it's actually up a little bit, and it's in the range of about 30%, so they don't have a lot of turnover either while doing this. I believe their Aligned Technology has been in the portfolio for 7 years, just as an example. So these guys are not traders, they're investors.
Mark, I'm in the middle of writing a class right now called The Myth of the Lost Decade, and graphs like this I think are important for people in investment clubs that are talking to other investors to internalize and think about, because while the lost decade is certainly evident on this graph of the S&P here, it's certainly not to be found on the graph of the Buffalo Small Cap, and there's a lot of other mutual funds and a lot of other indices where you won't see the lost decade. All this talk that the people on TV put us through telling us that you went for an entire decade in the 2000 to 2010 without making a penny needs to be refuted occasionally, and people need to know that you can make money in a market that appears to be flat.
Yeah, absolutely. Back in St. Louis, we talked about how you didn't have to be a lost decade if you were doing this. And Lori, did you have a comment?
I just had one thing. Are you recording? Did you start the recording?
I did start the recording, so we'll make this available to, we're kind of worried tonight for those of you in the audience. You may be fortunate to get a seat. We may actually sell out tonight, and we'll probably have an encore performance, and we will make the recording available within a few days. So, thanks.
There's also a comment here that's saying that your chart is a year old.
My chart is a year old.
It says week of November 12th, 2012.
Oh, I think I just accidentally left the cursor in the wrong place when I was taking the snapshot. Yeah, I can. It's referring to this little dot right here. That's actually a 15-year chart, though, so it's the 11% is good over 15 years. I just accidentally left the cursor in the wrong place. Well, talk about a very observant fact checker there. They're hired.
Yeah.
All right, just a really quick comment as to what we know is important in the modern investment club movement and manifest investing. We're going to be spending a lot of time focusing in on two parameters tonight. I just wanted to make sure we define those two very quickly. I'm not going to spend a lot of time on it, but we are going to focus in on growth. When we talk about growth, we are talking about top-line growth. We're talking about what you might think of as trend or forecast growth in our analysis of business models when we take a look at the historical and projected performance for the companies that we study. So when we're talking about growth, we're talking about a regression or a best fit analysis, or however you want to think of it. And we will be spending time talking about that. So for any company, we're basically taking that track record and looking at the regression or the trend, however you want to think of it, but it's basically this trend going forward. And then when we talk about quality at manifest investing, we're basically on the shoulders of George Nicholson, grandfather of the movement, and Benjamin Graham, who basically said these are the four main components of quality. And we basically rank them from 0 to 100. Anything above 80 is in the top quintile. 60 to 80 would be in the second quintile. But we take and we rank them, and again, that's where the quality comes from. I'm not going into it too much other than you could think of it as either a snapshot industry study, or for those of you who do stock comparison guides, it's simply a scored comparison guide.
Mark, we have a question from Audie. I'm going to unmute him, and Audie, go ahead and ask your question.
Thank you. In a lot of BI literature, the 5-year time horizon is referenced, and I can really find no basis in fact for that. I know that we used to discuss the rationale as the period of a business cycle, but given the past two, the financial crash and then the tech bubble burst, the 5-year period doesn't really hold up. What comment do you have on that?
it's true that the time between business cycles from peak to trough, or however you want to measure it, has been something of a challenge for the last several years. The 10-year historical period on the stock selection guide, I can't cite chapter and verse other than I know that that was intended, going back to the design of the stock selection guide, to cover 2 business cycles for the 10 years, and that's where the additional 5-year time horizon comes from. So yeah, the economy and business cycles haven't cooperated for the last several years, and that has been a little bit different. At Manifest Investing, though, we do maintain a 5-year time horizon, a constant 5-year time horizon for everything that we do. All right, let's go ahead and dive into the Forbes work here tonight. The Forbes methodology, just to give you guys an idea where the stuff comes from, they basically took a big pile of companies and they sorted out, weeded out anybody that didn't have an annual revenue between $5 million and $1 billion. So they really were trying to stick to the smallest of companies. And they also threw out penny stocks. They didn't allow anybody in that had a stock price lower than $5 a share. And Lori, you'll love this one. They excluded REITs and limited partnerships. So that keeps the list clean for investment clubs. They left out the utilities also. So keep in mind that those companies, those type of investment vehicles, were eliminated from it. Ken, I'm getting a little bit of typing feedback. So, all right. They basically took a look at some growth characteristics and a return characteristic, using return on equity to just kind of weed down to the final list and rank them and come up with the leaders. So that's how they did it. Okay, in keeping with what Lori wanted to see, this is a look at, as Ken said, we've been doing this for many years now, and every year we basically sit with the 100 or two, at one time it was 200 companies, kind of whittle it down to the dozen or 16, in some cases nearly 20 stocks that look most favorable to us, the companies that look to be of the highest quality with decent return characteristics. A lot of times they're not paying a lot of attention to the future potential of the companies in this best small company list. They're really just talking about, here's a high quality small company, not necessarily whether it's on sale or not. So that's how you get the list whittled down to just a subset of the original, in this case for this year, 100. But going back to 2006 and every year after, you can see how the companies that we chose in our dashboard, we're going to look at the specific companies here in a minute, have performed year in and year out. The ones for the particular years, 2006, you can see outperformed the market, again outperforming the Wilshire 5000, just comparing it against the total stock market, and you can see that in 2007 and then 2008 was a banner year. Had a little bit of suffering in 2009 and 2010, and we will dig into that and see if we can't see some of the cause of that. And again, last year was one of the best years we've seen in terms of absolute performance in that 30% range. Keep in mind that the overall stock market from October to October was up 25%. So even though this absolute return is higher, the relative return back here is actually better. So the best year we've ever seen is still the stocks that came out in October 2007, the 2008 list. When you take these and stack them up and just basically build a performance composite of all the years, you end up with an annualized rate of return of 17.4%. Again, that's nothing to sneeze at. And against the S&P, or excuse me, the Wilshire 5000 over that same time frame, that's actually checked in at 15.1. So again, we're seeing a relative return from these Forbes stock selections of plus 2.3% over that time frame. So again, we want to just kind of look for some patterns and stuff we might take away as we go through this stuff. All right, here's the actual companies year by year. I know this is a little bit noisy, so let's kind of break this down. This is all the selections going back from 2006 through 2012, color-coded, and they're actually placed on this histogram chart, charting relative return. Again, relative return is going to be the actual return achieved on those stocks, annualized, minus the annualized return on the Wilshire 5000. So you've got some from way over here on the left that dramatically underperformed the market, over to the ones on the far right that were basically giving a standing ovation. And kind of neat, just looking at it from side to side. Again, if you drew a line right down the middle, anything to the right of this line, right down the middle, would be selections that have outperformed the market over the period shown. and anything to the left would be the companies that have underperformed. Any reactions to this just off the cuff, Ken?
Yeah, Mark, what I'd like to point out is that very farthest column to the right, the greater than 20% column. Those in my mind are home runs. And you know, when you're managing a portfolio, you can hit a lot of singles and you can strike out a number of times. If you hit a home run once every 8 or 9 or 10 stocks, however, you end up with a pretty good relative return. And I'm looking at that home run list, and there's certainly stocks that we've continuously talked about at Manifest Investing for the last 5 years, 8 years, whatever the time period is, starting way back when with Neogen and going through Portfolio Recovery and Stratasys and Mesa Labs and eGov, that's really NIC Corporation. There's a lot of great stocks on this home run list, and like I said, you only have to hit a home run maybe once every 9 or 10 times to end up with a pretty decent portfolio. I should include Buffalo Wild Wings and Middleby in that list as well.
Yeah, Buffalo Wild Wings shows up quite a bit over there. So does Portfolio Recovery. You know, Neogen, we might as well start with that one. One of the things, by the way, that you do notice is that 2006 and 2007 having the most time to mature, you actually have more of those kind of move into the middle. If you notice some of these bluer ones towards the middle of the chart. But Neogen, that one has been quite a find for many of the investment clubs nationwide, but particularly in Michigan. This relatively small company for us, it kind of became the poster child of you can have a very high quality, up straight and parallel situation with the smallest of companies. And Neogen has delivered. I think those relative returns are actually in the 28% range over an 8-year time frame. We'll see that when we actually go to the portfolio. But again, almost kind of a poster child for the type of high quality company that is discoverable in these small companies.
Mark, I've been chatting offline with a couple of folks here in the audience that were wondering if companies had a lot of history, and I think one of the lessons that you take away from a chart like this is that you really do need to look at the highest quality small stocks if you're going to add them to your portfolio, and that means that you really should have some history that attaches to them. Maybe not a full 10 or 12 years of history, but I like to show at least 3, 4, 5 years of history. And more importantly, I like those lines to be up straight and parallel, just the same exact things that I demand when I'm looking at medium-sized and large companies.
Yeah, I think one of the other things that this kind of reaches out and says to me is, you know, for one thing, they're not clustered and spread kind of evenly with kind of a, you know, a bell-shaped type curve. And there's a little bit of a bell curve here, but not much. We have a whole lot of stuff going on at both ends. And I think what that underscores is just the intuition or instinct that you have. When you're dealing with small companies, it's actually pretty easy for them to go either Ken's home run or grand slam in some cases, or strike out to the left. So they have a higher propensity to either please you greatly. And again, I mean, we're thrilled to see that this chart is actually pretty heavy over here. There's quite a bit of activity at 8% and above. And again, keep in mind that's relative return. So 8% and above, and actually not that bad over here on the left. But let's go ahead and, you know, let's talk a little bit more about that distribution. We'll come back and take a look at perhaps some more of these companies. But one of the things I wanted to point out.
Mark,
yeah,
I'm going to insert a statistic that Dan is giving us right now. Dan is citing information from the National Bureau of Economic Research, and that's the private nonpartisan nonprofit group that determines the official start and ends of business cycles. And from 1945 to 2009, the average business cycle has been just a bit over 5 years. So that 5 years might still be intact, even though we have some aberrations to the number in the most recent business cycles.
Absolutely. The average is probably, as he says, very close to 5 years. It's just that we've had some, you know, 2- and 3-year intervals and 10-year intervals to kind of keep things interesting.
And then Nancy would like to know, Mark, if you could define again relative return.
Okay, relative return is, again, pretty straightforward. If you're talking about, let's say your personal portfolio went up, had a rate of return of 30% last year, 30% last year, and the Wilshire 5000 went up 25%. We basically take your 30%, subtract out the 25%, which you would have gotten just investing in the Wilshire 5000, and your relative return, the amount that you actually beat the market would be 5%. So that's how you think of relative return. The average investment club quest, or virtually all of us here, is to target a relative return of about 5%. Again, knowing that if we got 2 or 3 or 4 or 8, that's fine. But on average, we're basically targeting somewhere in this 4 to 5% range on a relative return basis. Does that help?
Yeah, she said thanks.
Okay, so let's go ahead.
John is pointing out, which I thought was interesting too, there's a couple companies like CRR, which is -20 in 2011 and +20 if you picked it in 2012.
Exactly.
QSI is like that too. It's if you picked it in 2011, it wasn't so good, but
yeah, it's neat that you're right. CRR shows up over here and it shows up over here, so I guess that's just a matter of when. And QSII is fascinating because it's everywhere on here. You watch for it, it's there, and it's right in the middle. I think it's on here 6 times. Here's another one over here. So yeah, over the long term, Ken and I were talking about QSII has quietly gone up like 80% in the last 8 months, and very few people have noticed. And
I guess when I was looking at this in your original, looking at some of the old dashboards, I was wondering if you had captured the projected returns for these at the time they were added to the list.
Well, keep in mind
seeing how that correlated with how they actually came out.
Yeah, keep in mind that very often those are going to be basically across the board in the sweet spot. So we're basically looking for returns somewhere out in this range from all the stocks on every single one of those dashboards. So that's going to be true across the board. I did capture a few of them, but we'll go through and take a look at those also. Some neat stuff.
Mark, Ed has his hand up. I'm going to unmute him. Ed, go ahead.
Yeah, when you have a company that is in several different years, that just means that it made the list for those years, or is there some other determination of whether it's here for a certain year?
It made the list every one of those years. So, for example, Neogen has only made it once, but it's this one over here on the far right.
And when it shows it up for a particular year, the relative return is just for that year.
Yes, and you'll see that as we go through the dashboards here in a minute. But this just kind of shows what we're looking for is patterns here. Trying to be true to what Lori wants us to do. What can we learn from this? So far we take away the fact that these are less predictable by their very nature. They're inherently less predictable. We know that. And just for comparison purposes, let's go ahead and take a look at this. Many of you are very familiar with the rule of 5, that for every 5 stocks you pick, and that's what Lori's asking about. We're basically aiming for 5% plus or minus on all these stocks. And, for every 5 stocks that you build a forecast or an expectation for, 3 of them should ultimately resemble your forecast given enough time, or 60% of them. One of them will be Ken's home run, significantly outperforming, and another one of the 5, or about 20% of the stocks that you actually do studies on, will significantly underperform and end up out on the left-hand side. And you can see just kind of compare this to the slide we just have up there. This is the Manifest 40 of the most widely held or widely followed companies by our subscribers. These are a different breed of companies, and you can see this is actually starting to form something of a bell curve. I mean, it's not a perfect bell. It's some type of distribution, but what I draw everybody's attention to is let's look at, right down the middle of this thing, and what do we see? Aflac, Johnson & Johnson, Pepsi, Procter & Gamble, Wells Fargo, Exxon, Abbott. Here's one of the small companies right here, BioReference Labs, and here's another one, Quality Systems, coming in the middle. But again, these are kind of those core companies that we tend to think of. You can throw Stryker, Walgreen, all those type of companies in there. And the same thing holds true for these over the last 8 years that we've been tracking them. Every once in a while, these become home runs like Apple or Buffalo Wild Wings or Cognizant Technology or Portfolio Recovery. But the thing I draw your attention to is this really looks quite a bit different than the preceding graph. A lot more predictability. It's the reason that we hang out in these companies quite often when we do our explorations and discussions. And so again, dramatically different. Just a quick reminder that the rule of 5 doesn't apply quite so well to that collection or that quest for the small companies.
I'd like to officially congratulate you, Mark. This is the first time that we've sold out a webinar.
Now, that means we're in trouble with people not getting in.
Message just came up on my machine that we're officially sold out.
That means that there's a secondary market developing if you guys want to sell seats and take off for the world. No, I'm kidding.
Scalp tickets.
Scalp tickets, if only.
Mark, we have a question from Audie. Audie, you're unmuted. Go ahead.
Thank you. This distribution appears more to me to be bimodal, and it underscores my previous comment that the business cycle of 5 years from the past should probably be reconsidered. I'm not sure what it should be, but we can see the growth from 8 to 10, and thus more recently is much greater. And for the lower negative growth rates, we have a different kind of a distribution. The characteristics are not even close to similar, it appears to me.
Yep, it's a type of thing we could throw a bunch of statistical analysis at it. I just tend to think of the ones on the right as being hot stocks, and in some cases hot over 8 years, in some cases slightly less than that in the Manifest 40. So interesting stuff. Let's go ahead and kind of look for some other patterns. I did want to point to this one. This is one of my favorites when discussing the quest for smaller companies. You can see that 2008 was a very good year for the Forbes Best Small Companies. Look at all of those clustered in the home run pile. And over on the left, the strikeouts in 2009 and 2010. And I think this is an opportunity to, again, we've been talking business cycle. This is a time to underscore one of those things that Peter Lynch tells us. Let's go ahead and take a look at the next slide. This is the Buffalo small cap slide just to give us a background of small company stock price performance over a 10-year period with a look at the recession. You know, Dan was just quoting the statistics, the official Great Recession that took place starting in Halloween 2007 and went for about a year and a half. And one of the things that Peter Lynch always used to tell us, again in honor of tonight's Boston Red Sox, but Peter Lynch used to talk about how when we're in a recession, that's really the best time to increase your emphasis. You know, always be shopping for smaller companies, but when you're in a recession or seem to be coming out of a recession, those are the times when those things can really get on fire. And I think we kind of see that here. In the graphic that you see here, those of you that followed some charting will recognize that condition up at the top as an oversold condition for small company stocks. And sure enough, 2008 turns into a pretty good year, whereas 2009, 2010, 2011, a little bit more lackluster, and really we're not seeing any oversold conditions here. So again, we'll give them time, but these were not periods coming out of recessions. So again, just that quick reminder from Peter Lynch that if you're in a recession, you probably should you know, up your emphasis on small company stocks. Thought we'd also take an opportunity to talk about, I actually ran some numbers one time saying, what if we left the educational services stocks out of here, because we've got 3 appearances of Strayer over here on the right, and you can see they are from back in that 2009, 2010, 2011 time frame. Actually, there is a 2008 in here. And then we also have appearances by APEI, which is a stock that has actually looked pretty good to us over the years, and Capella. And these have all basically kind of hurt the overall performance of the portfolio as a group, all coming from that same educational services industry. And again, just to kind of make the point, every once in a while, this is one that Ken has taught me here over the last few years, it's kind of like walking into the path of an oncoming locomotive. Every once in a while in investing, there are just external forces. In this case, not only the supply and demand situation with that type of education, but the federal legislation and investigations and some of the nonsense that was going on with the Apollos and various others, including Strayer. These external forces have simply been extremely powerful. They got oversold, or excuse me, overbought back in that 2008-2009 time frame when it was being added to the Forbes Best Company list. But you can see that it's kind of been nothing but downhill. And this is one of the higher quality companies in the entire industry. And this middle indicator here is momentum, and this is kind of phenomenal. I mean, this Strayer has basically had no momentum or negative momentum for an extremely long time, with no signs of recovery that we can see. And it's also an opportunity to talk about generically about the situation that I have learned as an investor, that when a company like Strayer, just using Strayer kind of as a poster child here, there are companies that just simply fall into the falling knife category. And you can see the stock price decline here in the green bars, and it has not abated yet. But what bothers me here, or the thing that I've learned, is I never average into these or try to go back into them when the quality is degrading, as you see here. Started out as a very high quality company up here, excellent quality, and has deteriorated down into a sub-average quality company. There was a little bit of a hiccup here for maybe a ray of hope. Anytime I've got a declining quality ranking on a company now, I'll basically ignore those type of return forecasts and just kind of say, hey, this is basically the only way to protect yourself against a falling knife, and that situation has not stabilized and gone back the other way. Nicholson used to talk about, watching for multiple quarters of improvement, and we certainly haven't seen that here. So Ken, I guess I should have listened better to you, and so should the Forbes pickers on the best company list. One other thing that I wanted to point out by some of these smaller companies, here's a company that kind of came into our crosshairs the last couple of years, Solar Winds, company out of, I believe, Oklahoma City. Has nothing to do with solar or wind. It's an IT company that apparently has some pretty good solutions. And you can see that they were on the list in 2011. They were our best performer a year ago, going from 20 up to 60, as you can see here on the price chart. And then the last year has not been quite so favorable. You can see between 2012 and 2013, they actually have gone down. They actually show up on this year's list. It's still a fairly interesting company, but it is a company that has gone through an overbought situation, and the momentum has been kind of drained out of it. I do think that the long-term prospects for this company are quite good, but quite a roller coaster / Roman candle, and the type of behavior that you can see in this type of a situation. Any comments or questions at this point before we dig into the individual years? We'll just kind of roll through these to make a point. Anything show up, Ken? Or Lori?
No, though apparently somebody knocked at the door and couldn't get in.
Yeah, we'll probably have a couple of those.
Which, I didn't realize, but go to meeting tells you.
Yeah, in the middle of it. I don't know if I can make that not show up. Does that show up on your screen also?
It was on mine.
Okay,
I don't know.
I think it's just on ours.
See.
Anything on your end, Ken? Or are you just doing a dance over avoiding Strayer while I suffered? Did we lose Ken?
Maybe he gave up his seat to that guy.
Maybe he got bumped out of the room. Okay, well, we'll keep pressing on here. Okay, now to the individual companies. And just to kind of give a quick look at the individual dashboards for every one of these years. This is the 2006 list. Again, one of the oldest ones on the ones that we're featuring here. Here's your Neogen. what we do at the time of selection, again, this would have been Halloween 2006, we take and invest $100 into Neogen. And $100 has become $765 over approximately 7 years. And the number of shares is dividend and split adjusted, so it is literally $100 becoming $765. So as we scroll through these individual dashboards, they are sorted from top to bottom by value. In other words, the ones at the top are going to be the ones that have done the best. The ones at the bottom, in this case WTI and SuperTax, are going to be the ones that have been the weaker. $100 invested in either of those two is worth $65 or $70 some 7 years later. So again, the ones at the bottom have performed weaker. The stronger performers are going to be at the top. And one of the things we started noticing after doing this for a few years was that as we kind of scroll through these, not only for the Forbes Best Small Companies exercise that we do, but in many different cases, paying attention to the quality and the sustained or sustainable quality of companies seems to take on an added importance. And notice that kind of the ones rising to the top here are the higher quality companies, with the exception of Quality Systems, and that one's been through kind of a special situation. Does that mean Ken's back? I hear him rummaging around, I think.
Ken is having audio issues, but Ed Ruggiero has his hand up.
Okay.
Ed, I unmuted you. Ed, did you have a question?
Yes, the question about Strayer and educational companies. There was the federal government mending, in that. How does, when the federal government got involved and the reaction in the company's performance rank up? Or was there much of a lag there? Or because I'm wondering, today we have Obamacare starting up, and is there going to be a similar type of reaction in medical-related stocks? Perhaps. Yeah.
Well, I think if you go back to the educational services companies specifically, it was really especially in the higher quality companies within the group, it was a very long, protracted decay or deterioration. There were a few companies in the group, like Education Management and Career Education out of Chicago, that had rather severe accounting issues that pushed them down overnight. So there were some companies that had those type of issues. There were others that had operating problems that really aggravated them. But as a group, it really has been kind of a slow bleed, if you want to think of it that way. What you basically see during your stock studies is the stock price continues to decline, and basically it takes a while for the fundamentals, including analyst estimates, to catch up. So in this case, all you could do is basically watch this baby over time, and like is shown here in the picture, Strayer went several quarters. These are months down here. Several months of a relatively slow decline. Here's a pretty good decline back towards mid-2011. But, I mean, that's just basically kind of a slow atrophy, if you want to think of it
Testing.
that way. You're back, Ken.
Well, thank you. I am back. Okay.
I've been giving you all kinds of credit while you've been out running around, and your wisdom of avoiding the educational services stocks.
Well, I've been able to hear you the whole time, Mark.
Oh, okay.
I just haven't been able to speak. So, Mark, we have a large number of folks with their hands in the air.
Okay.
Mary Lou has a question. So, Mary Lou, I'm going to unmute you. Go ahead.
Okay. At one of the other graphs, you talked about the graph showing that the stock was oversold. I was wondering if you could explain that.
Okay. One thing I would refer you to is stockcharts.com. That's a free site that you can actually go and search on the term overbought or oversold. In this case, okay, it's referring to this indicator, which is called a relative strength index. Anytime that gets up above 70, you can see kind of the solid line at 70, it can be considered temporarily overbought. Now it can remain overbought for a long time, but temporarily overbought. Anytime it's below 30, anytime it's below 30, it can be oversold. So that's why we're basically pointing to this actually hasn't reached oversold yet, even though it's been in decline for almost free fall for almost 4 years. So you can go and actually read more about relative strength index, overbought and oversold, and stockcharts.com, they have a tutorial or a chart school, and that'll give you all that you need to understand that. When you hear the gurus or talking heads on CNBC talk about a stock being overbought or oversold, oftentimes that's what they're referring to, this technical price-related condition. Okay?
Mark, Ann Manning was asking, I assume that quality is also one of your screening criteria. So if you looked at the historical, at the quality level when these stocks were chosen, they would be pretty high.
They had to be at least good. They had to be at least 60. So any of these companies that are down here are companies that have deteriorated from levels of at least 60. So again, that's what we began noticing as we're going year to year, and we'll scroll through some of the years here and you'll see what I mean. You really want to be looking at sustainable, credible growth and sustainable quality. And the ones that have performed, I mean, look at these numbers up at the top in the hundreds for 2006. Let's go ahead and go to the next one. Here is 2007. Top performing company being DXP. Again, $1,000 invested around Halloween 2007 is now worth over $400. And down here at the bottom, Healthways hasn't done nearly as well. $100 invested is now $28. And again, just kind of looking and getting a general feel for the chart, notice that the higher quality companies, again, with the exception of this kind of an outlier for DXP here, but in general, I think it's fair to say that the higher quality companies, again, are kind of like cream floating to the top of the mix here, along with companies that have maintained their growth. And again, I've told the story many times, many of you have heard it. I actually sat with Ken a couple of times when we're looking over these lists, and he basically would pick the ones out that he thought could stay at those growth levels or could stay at those quality levels. And one of the other things that you have to watch for when you're dealing with the Forbes list, again, it's just math, and they're doing some fairly rudimentary math. A lot of times when you're dealing with a cyclical company, they could be measuring trough to peak situations. And you really have to be more concerned with, again, long-term core growth of a company, and watch out for the vulnerabilities in the math that come along with those cycles. And that's what you see with some of these on here. Perhaps this Eastern is an example of that.
Mark, can you clarify again? This was a dashboard created around Halloween in 2007, but it's completely up to date to tonight. Is that correct?
That is correct. And so we're
about $100 invested around Halloween 2007 for portfolio recovery is now worth about $400, right?
That's right.
So it doubled and then doubled again in
6 years.
About 6 years.
Yep.
Okay.
And Middleby and Buffalo Wild Wings. So again, these are the companies that are showing up in that home run cluster.
So there's a question of why was there the drop in quality for some of these, especially like DXPE?
Well, it's a great question. I mean, if you look at the components of quality, it has to either come from a change in investment grade or financial strength, or consistency or stability of earnings, or in some type of a drop-off in profitability or growth. And again, keep in mind that we always compare the growth and profitability of any company to a peer group. So in order for that number to drop, what it's basically saying is it's not only dropping or changing and going lower, it's going, faster than its industry. And that's how you can see that type of deterioration. Or in the case of an Eastern, and again, I haven't studied this company in any great detail, but it's probably fairly economically sensitive, and it was probably going through one of its peak moments back in 2007. And over the longer term, it's probably a fairly bumpy ride. Well, I know it is by that EPS stability rating here of only 28. Okay, so again, just think about what could happen to change the quality rating of a company. You could have a downgrade in financial strength, You could have increased volatility in earnings actually reported and forecasted, or a relative change in growth or profitability, and that's what you're seeing. These companies down at the bottom did not sustain. They actually went through some form of deterioration that took these companies down. Okay, so let's go ahead and move on to the next year just so you can kind of get a feel for this. You'll see there's a very powerful, very common theme in these, something that Ken talks about all the time. Again, we're talking about this is actually the best performing year of any. $100 in Stratasys invested 5 years ago around Halloween is now $900. Okay, and this is a high growth company in that I believe it's in the 3D printing area, and just kind of notice that top to bottom here, the quality has maintained pretty well for these companies from 2008. You know, less cyclicality in some of the companies perhaps, but notice that the growth has actually maintained in double digits for many of the companies here at the top of the list. So again, just in general.
Mark, the point that I'd like to make is that if you look at the SSG, or the earnings growth line and the revenue line for a company like Buffalo Wild Wings or Jack Henry or FactSet Research or BioReference Labs or Decker's Outdoors, you'll find pretty traditional SSGs with lines that are extremely straight and extremely parallel at the time that the study would have been done in 2008. So if you ask of your small companies the same thing that you ask of your larger companies, you have the chance of really finding some hidden gems on this particular list from Forbes. Today, a lot of these company names are familiar to the better investing community, but when you and I started talking about Neogen 7 or 8 years ago, or started mentioning that Buffalo Wild Wings was an extremely interesting play 5 or 6 or 7 years ago, people didn't know about those stocks. Nobody in the community, or virtually nobody, talked about them. And to find them, all you need to do is rely on the same things you learned when you were studying medium-sized companies or larger companies. Insist on some history and insist on some straight lines.
Absolutely. You'll see it year in and year out. Let's go ahead and click through the last few years, and then we'll take a look at some of those companies that fit the characteristics that Ken was just talking about. Here's 2009. Again, same thing holds true. The top performers are at the top. $100 in Buffalo Wild Wings 4 years ago is now $300. And again, notice that in general, again, not universal, but in general, look at the high growth, the average growth of the companies at the top versus the average growth of the companies at the bottom. Look at the quality and how the quality is maintained at the top versus at the bottom. So again, the stuff that we're taught to look for, it works. It doesn't work without exception, but it works overall. So there's 2009. Let's go ahead and scroll. There's a couple, Meridian Bioscience, Cincinnati company that came to our attention there. Capella, unfortunately, came to our attention back in that time frame. Again, Strayer's kind of bringing up the rear here at ouch levels. But again, some kind of fun companies. This one here, this one has been very good to some of the investors in this community. Synaptics, and it kind of hit the radar screen back in that time frame. Here's 2010, same story as before. Although this is only 3 years, so $100 invested in portfolio recovery is now nearly $300. And again, I want to point your attention to the fact that in general, up here at the top of the list, your better sustained growth companies are hanging in up there at the top. Again, up straight and parallel does matter when it comes to this type of investing. And same thing is true over here. In general, some of the higher quality companies have continued to float to the top. There's some fascinating names on that list that have kind of hung in there over the years. So let's go ahead and wrap up the historical stuff by looking at 2011 and 2012. Portfolio recovery, again leading. What an outstanding performance. That's just a couple of years. 100 becoming nearly $300. And again, notice that for the most part, all of the companies in the 2011 list have hung in there with respect to quality, and growth is actually maintained pretty well also, highlighted down here in green. So it's hanging in there. So we'll watch it and see if there's any deterioration going forward in some of those companies, but in general, pretty good. 2012, again, one of the best years in the history of keeping track of this stuff. Here's one of your favorites, Ken, rising to the top. eGov nearly doubled over the last year. And again, hasn't had a lot of time, but notice that, again, quality being fairly well maintained and a really nice growth rate hanging in there pretty well. I would point out that one of the companies that has struggled the most is one of our favorites to at least study around here, Landauer, and they're having trouble digesting a relatively large acquisition that they went into approximately 18 months ago, and it's really put kind of a we'll just call it a management challenge presented to the company, and it's definitely showing up in the results. So again,
I think anytime, Mark, you can hold up a year-old list and show about half of the list having met that mythical 15% growth rate or better, I think you're looking at a list that has great potential for investors. I mean, you go all the way down to FactSet, which has exhibited about 20.5% growth in the last year. All those companies would be fine additions to any portfolio for the past year. And I think if you do SSGs on these top 7 or 8 or 9 or 10 companies, you'll be very pleased with the nature of the visual analysis. You'll be looking at lines that show exactly the same things that are important in the medium-sized and large-sized companies that we all love to put in our portfolios.
A few of those are actually going to repeat on the 2013 list, and I would point out that what Ken is saying, that if you go back all the way to the 2006 list, about 50, I think it's 54, 55% of the companies have actually outperformed the market, which would be kind of the case here for 2012. So let's go ahead and talk about the 2013 list. Ken, you want to kind of walk us through the portfolio report card?
Absolutely. This is a mainstay of manifest investing. It's at the heart of all portfolio analysis and portfolio management. I'm here to tell you, as a person that belongs to 2 model clubs and a family club and a regular plain old vanilla investing club, I'm here to tell you that Manifest has greatly simplified our portfolio management. We sit down in a meeting in these modern times now, and we look at this report card. We like to see our par values somewhere 5 points ahead of the market average. And if this is current today, the market average was 5.6%, and that's based on, I don't know, what do you have in the database now, about 2,500, 2,600 stocks, Mark, something like that?
About 2,500.
Okay, so if we were to do an SSG and figure out the par on all 2,500 stocks, put them on a list from top to bottom, the one in the middle would have a potential average return going forward of about 5.5%. We like to aim 5 to 10 points above that. That's where that sweet spot number comes from. And this portfolio of the best small stocks has a par value of 12.7. That's certainly in the sweet spot. I love quality values at 88.9. That's really high. If you can keep your quality of your portfolio somewhere between 70 and 80, you're doing a wonderful job. There's nothing wrong with having it at 88.9, but sometimes that's difficult to achieve and still end up with a good mix of small, medium, and large stocks. These are all small, great quality. The growth is exceptional. The growth for a typical portfolio as a whole, you say it's great when it's down around 11, 12, 12.5%. Here we're looking at a group of companies that are growing on average. This is sales growth now, folks, growing on average at 16.5%. That's the very definition of a small company, faster growth. And remind yourself, with that faster growth comes more risk. These companies are much more risky to invest in. You remind yourself, you didn't see a bell curve on those returns in the very beginning of this presentation. You saw a big group of great performers and a pretty equally large group of stocks that have not done very well. So you have to watch them more closely. They're more risky, but they have the potential for much more reward. The next number I look at on this report card is financial strength. I do like to see my total portfolio's financial strength somewhere around 75 or 80. So this is a little bit low. But again, I would expect that because of the nature of the companies on the list. smaller companies don't have financials that are rated as highly for the most part as some of our larger blue chip companies. Same thing with earnings stability. You'll find a lot of companies where the lines look like a roller coaster designed by somebody at Cedar Point. But the EPS stability of 70, if this were a regular diversified portfolio, I might want it a little bit higher, but you know that's really not that bad. That means there's an awful lot of companies on this list that have earnings lines that are pretty straight, pretty stable, and therefore fairly predictable going into the future.
Yep, good stuff overall. Just for kicks, I threw the 100 best small companies into a portfolio. Like Ken said, I think there's 98 of them covered there, but just to kind of see where the emphasis is these days, and it's down in technology. Amongst the companies on this best small company list, it's technology. I was kind of surprised to see energy this low because energy's been kind of, pardon the pun, hot in the Forbes small companies, and I was kind of surprised to see some of these a little bit lower, but again, technology is what they say is most favorable these days. So let's go ahead and talk about...
Mark, we should remind ourselves, too, that Forbes threw out what they considered all the financial companies from this listing. So that's a reason for that 1% financials on the list there.
Yeah, I don't remember who snuck in. I have to look.
Yeah.
All right. Well, here's the dozen or so that we thought kind of made the list. Again, searching on the basis of what we've been talking about here tonight. Sufficient return, a suitable return forecast in combination with excellent or at least a very good quality rating, and in combination with a decent and hopefully sustainable growth rate. Even if it naturally grows and slows down a little bit over the next 5 years or so, we want to see growth that's relatively sustainable. And here's the list that we come up with. Again, SolarWinds making its third consecutive appearance on the list. And again, it's been hammered in recent months, so it's got a fairly elevated return forecast despite some pretty decent fundamentals. We're going to take a look at these, kind of stepping through them one by one, but just to give you kind of a feel, some very interesting names on here. Proto Labs, we'll talk about. Mesa, there's some repeat performers on here. Massimo, Synaptics has been on the list before. Lumber Liquidators was Bernie's Groundhog Champion stock from last year. So again, some fairly recognizable names, though many of us in the community have been kicking Echo around as a competitor to C.H. Robinson, perhaps Expeditors International. So again, from top to bottom, some pretty decent companies. Now notice, we invested a few days, that $100 was invested just a few days ago into these companies, approximately 10 days ago. $100 into QuestCore is already up 24%. That's why some of these return forecasts are actually down a little bit. For example, at the bottom down here, Synaptics, it's gone up 13% in a little over a week. So the return forecast has actually been bumped down. Trust me, when it was, I'll show you the list at the end, but when we started this, it was at a sweet spot return forecast. So we're just kind of step through this, and Ken and I may have a few thoughts to share on them. Again, SolarWinds. Again, this is an information technology leader out of Oklahoma. The quality rating is extremely impressive. Pretty good characteristics across the board. And again, it's got a limited span here. One of the things that we do is tack on a couple years of actual forecasts to give a better look at the end of this year and next year for the company. But this is a company that I'm still relatively high on. I expect it to be kind of a roller coaster. Notice that the stock price has dumped down from 60-ish all the way down into the 30s right over here. And that did result in a fairly elevated return forecast there for a while. But again, if you can stand the roller coaster of that type of thing in a company that has a pretty promising outlook and a fairly strong growth outlook, could be fairly interesting. Any thoughts on that one, Ken?
Well, I actually own SolarWinds. It's been a bumpy ride so far, but I really believe in regular investing, and I haven't been afraid to continue to make small additions to my solar winds holding. I've probably held it now for about a year, maybe a little bit longer, and every 3 or 4 months I've been adding to the position. So it's about even for me right now, but I think that I look at these lines, Mark, and you know, when I see them lining up, all those data points lining up like that, and I see the parallel nature of the revenue line and the earnings per share line, I think I've found a company that is going to be able to produce and continue to produce for a period of time, and I don't really care if the market hasn't discovered it yet.
Exactly. All right, let's go ahead and talk about Echo, ticker symbol ECHO. And again, we haven't followed this one for quite as long at Manifest, but some pretty decent business model characteristics here too. Again, we're focusing in on quality and growth when we talk about these companies, focusing in on this trend line up here, something in that 20% neighborhood. I do get a little bit of pause here when I see a little bit of deterioration in quality here. You can see there has been a little bit of a drop-off.
You know, Mark, I was just looking at that exact same thing when this slide showed up here, and I'm telling myself, you know, not to get really worried about it until that line breaks somewhere at the 75 point or lower. I've watched a number of these smaller companies bounce around in this very high quality number between 80 and 100, and I think that's relatively normal for these small, fairly volatile companies. Again, I point out the quality of all the lines, check the data points out, check the straightness of the lines, and again, just for the sake of disclosure, here's another company that I own in one of my IRA portfolios. It's doing fairly well right now.
When I grow up, I want to be just like you so I can own all these companies too.
Well,
how about
I'm not
this?
Adopting, Mark. So
Darn it! I keep trying. All right, this one's no stranger to a bunch of people either. Newstar. It's one that's been talked about fairly widely in the community. Any comments on this one?
Well, my sister thinks that you're a genius, and by extension that I'm a genius, because this is one of the ones we put in her IRA account, and this has just proved to be a huge, stellar hit for her. In her account. I love the consistency of the quality. And again, you know, people that tell me they can't find small companies with histories, they can't find small companies with straight lines, Mark's just shown you 3 of them that have some history and that have good, solid potential going forward. Mark, we have a hand up. Butch's hand is up. I'm going to unmute Butch. Go ahead, Butch.
Just wanted to make you aware, Ken, you probably are since you own it. Echo came out with their third quarter earnings today, so people should be aware of that.
Well, what were they? Good, bad, indifferent?
They were flat to down a little bit.
Okay.
But not all that bad, but be interesting to see what Mr. Market does tomorrow morning.
Well, Mr. Market's been terribly vindictive to stocks that don't quite meet, so maybe it's a buying opportunity for me tomorrow, right?
I would agree with you.
Okay.
Yeah, that could easily happen. There have been a couple of stocks just completely hammered by, you know, missing by 0.3%. You know, come on. Interesting
Mark,
stuff.
We've been talking about quality. There's a fair number of questions about quality here. How often do you determine it in Manifest?
Well, we basically calculate it continuously. I mean, we're looking at the financial strength inputs continuously. The growth and the profitability, the industry comparisons. It's something that is at least audited once a quarter for every company. If it's a company in the Manifest 40, it's probably audited more than once a month. So we're constantly checking them. A lot of times when you're looking at a company like Newstar and you see a little bit of a downdraft here in quality, that could be something like a financial strength rating going from A+ to A. You know, and that's just enough to tickle it a little bit. So, I mean, that's the type of thing. Again, if I'm a stock watcher or if I own this company, you know, I watch that and then I kind of dig in and see, well, did something change? Did S&P downgrade something or Morningstar? Because all of that stuff is reflected in our figures.
Marty, I think he's asking about SWI. He asked us the very low financial strength, send a flag.
Yeah, the financial strength on SolarWinds probably reflects if they have a little bit of debt. I don't recall if they do or not, but they may be paying a slightly higher interest rate on their debt. Their financial strength rating, I'm guessing, is B plus or B plus plus, so it's got room to go up. I mean, their strength.
But that hasn't affected their quality ranking, right?
No, because of their growth and their profitability and the straightness of the lines on the graph that you see there in front of you kind of overpower it and compensate for it. And many times, Ken mentioned it earlier, a lot of times the smaller companies are going to have weaker financial strength just because they don't have the track record. And a lot of times they can compensate for that by the higher growth rates, in some cases higher profitability, and certainly when you see earnings per share consistency or stability that you see for a company like this. So yeah, it's just something to watch.
I guess Echo traded down after hours 10%.
Okay. All right, this one's kind of an interesting one. This is one that Lori was kicking around earlier with me, Proto Labs. And this is basically, as I understand it, and correct me if I'm wrong, Lori, these guys their main customers are the people who are doing 3D printing. And notice that there's very little track record here. You basically can't call this an investment.
They're not a 3D printing related investment. They do fast prototype parts for industries, but I don't think it's only for 3D printing. And
not only, but they make injection molding stuff and and the materials.
They prototype parts very quickly, injected molded parts for companies that are putting together whatever kind of equipment. But I read somewhere that it specifically is not to be considered a 3D printing type play.
Well, it's something that we have to do a little bit more homework on. Perhaps I'll read the Forbes summary on the company. It's compelling enough that I mean, they are marching right along if they hit these targets. And
yeah, it was just odd because Value Line had them under specialty chemicals, remember? And they're not.
That's right.
A chemical business at all.
But I do think this is an opportunity to be a company like, the companies who sold the television tubes to the television companies or razors to razor blades. I think this company has that type of potential too in a little bit. So it's definitely worth a closer look. But again, there's no track record here. So again, you're forced to speculate. And I would take everybody back to that mental image of the companies that were home runs versus strikeouts. I think this is the type of company that if you do speculate in it, I think you want to keep it on a very short leash. Ken and I were talking about leashes earlier today. This is the type of company that, if it doesn't hit the home run, it's probably one of those companies that is more vulnerable to ending up on that far left-hand side of the graph, would be my instinct on it. I certainly don't know what's going to happen, but
well, I think you'd want to look at what's the span of their business because fast prototyping and cost-effective prototyping would certainly be an attractive business. Prototypes are a huge expense and a big time delay on getting a new product to market. But if they're only serving a very limited range of companies, they might have a limit to how far they're going to grow.
Yeah, be a good start. Go ahead, Ken.
Claudia has her hand in the air, so I'm going to unmute her. Go ahead, Claudia.
What is the expected yield on small caps?
The expected yield on small caps?
Yeah, how much is it usually? Not much.
Well, generally it's going to approach zero. It's going to be 1% or probably approaching zero because in general, most of these are not going to be dividend-paying companies. Again, dividends are a substitute for a lack of growth, if you want to think of it that way. So as growth goes away, dividends increase as companies mature. And these are, in most cases, we're talking about companies that are immature. Okay? Here's another one, limited amount of data here, Del Fresco's. It's a high-end restaurant chain out of Texas. And pretty good reviews on stuff that I've looked, just kind of kicked around. But again, I think this one is vulnerable to kind of some speculation. Again, keep in mind, These numbers are still estimates for 2013 and certainly 2014, and just something to keep in mind. Again, anybody out there in the audience that can help us with this one would be most welcome. Yeah, Ken.
Mark, can you differentiate between small stocks as far as growth is concerned, as far as sales are concerned, and small cap stocks?
Yeah, we don't use cap for virtually anything at Manifest. Cap is just a measure of the value of the company. When we think of small companies, we think of companies that have elevated growth rates. And the trigger point for us is 12%. Any company growing at 12% or faster, we regard as a company that behaves like a small company. For those of you who want to fill in the other end of the spectrum, 7% and lower is what we would consider a large company. So that 7 and 12% are the break points. And again, 50. Go ahead, Ken.
Go on, Mark. Yeah. Okay. We should also remember that Forbes itself has defined small in their book as being somewhere between less than $1 billion in revenues. So
right.
We're looking at companies that have slightly different definitions here, but they complement each other. The two definitions do.
They sure do. And in fact, I think I threw in a graph just for people to take home based on our definition of sales. What would our best small companies be? So we'll get to that. Here's another company that, again, you might want to take a look at, IPG Photonics, ticker symbol IPGP. Again, it seems to be settling in and kind of maturing here over the last several years. And again, if these forecasts come to fruition, you're starting to see a pretty good pattern setting up here, along with a quality rating. Again, this one kind of displays some of that behavior that Ken was talking about that does seem to kind of bubble a little bit up at the high end. But this is a company probably worth taking a little bit closer look at. And again, these are all companies that we say have reasonably high quality studies, along with relatively attractive return forecasts. Here's one that I know Ken's been kicking around quite a bit here lately. This is a company that is taking off a little bit, bringing a few drugs to market, and Questcor Pharma. And it's got a little bit of bumpiness going on with some improvement in quality on the right-hand side, but this one's a tough study, I think.
Well, our brand new model club, Mark, isn't paying much attention to quality right now. They're made up of a lot of beginners, and we're making mistakes as the club begins its operation. But Questcor is one of the first stocks that they've put into their portfolio. So I hope it works out for the new club. And if it doesn't work out, it'll be something we look back at a year or two from now, and we'll say to ourselves, boy, that was a boneheaded thing to do.
Yep, it's the way to learn. And here's one that's a real favorite. I kind of put this in the Neogen camp, at least from where I sit, Mesa Labs. I mean, that's for a small company, that's about as up straight and parallel as you can get. It's not a big company. We're talking $60 million in sales for 2014. And look at the quality rating. It's obviously firing on all cylinders with respect to those comparisons. And I think I might go out and buy some of this one, full disclosure.
Mark M. Manning says Del Fresco's is a Houston restaurant. They might not have been public very long, but they're been in Houston a long time.
Well, that sounds like we need to come down there and check that one out, Ken.
All right.
We'll have to go to Del Fresco soon. We're on it.
Del Fresco's one night and that oyster place the other night, Mark.
Okay. We've got to be all over that. Okay, just to kind of round these out, just to kind of give you a feel for, you can find some of these type of companies. This is IPCM, IPC the hospitalist. And again, very, very strong characteristics, up straight and parallel, certainly for the last 2 or 3 years, and in combination with what the expectations are for the next year or so. I put this one a little bit on the radar screen, though, looking down here and seeing this quality condition. And again, it would just be a matter of kicking it up into a higher mode of vigilance and see if somebody asked the question of possible healthcare legislation impact on companies like this. Maybe do some digging and see if there's anything here that can be accounted for. Again, when these companies are followed by a relatively small number of analysts, a lot of times if they sour a little bit, you can get these type of bumps pretty easily.
This is also a very difficult company, Mark, to pigeonhole as far as industry is concerned. And sometimes we know that if you change the industry classification, you get different competitive numbers.
Sure.
Then this one's a very, very difficult one to decide what industry it actually belongs in.
Absolutely. And we did cover this one. It was a Solomon Select feature for you Manifest subscribers if you want to go back and look at what we thought of the company a couple of years ago. And we're coming up on the end. Another healthcare stock, another one that really high on my screen, Masimo. This is the non-invasive company that has the equipment in intensive care units, kind of expanding into other parts of the hospital for non-invasive monitoring of patient condition. And what's really kind of cool about this one is, you know, pretty good up straight and parallel on the top end there, but take a look that the stock price has been kind of in a slump here for the last several years while the fundamentals look pretty good. And again, the quality does seem to have kind of ebbed here a little bit, but not bad. Fascinating study. All right, let's just kind of wrap up. Here's just a quick list of companies that if you didn't use the Forbes criteria and instead stuck to growth rates, 12% and above, decent stability over here, and just some companies that might show up on a short list. There's some repeats on here, just kind of giving you some reinforcement. One that we'll be studying here within the next few days, Synchronos, because that showed up in our weekly update this week. But you see Newstar, you see Synaptics on here, Bernie's Lumber Liquidators. Some interesting companies on that list too.
That number 11, First Cash Financial Services, is a great study, Mark. Wonderful SSG. Those are pawn shops.
Yep, good stuff all around. So we can stick around and kind of take questions. I'll shut down the official recording, and we'll stick around and for those of you that are here live. But everybody, thanks for coming. We did run a little bit long, and hope that you enjoyed the session. Let me go ahead and recapture my screen here.